Imagine losing thousands of dollars on a real estate deal just because of one small mistake. It happens more frequently than you think. My name is Mike Chadwick. I've been in hard money for over a decade. In this video, I'm gonna go through some of the more common hard money loan horror stories and give you tips on how to avoid them.
So a hard money loan is really just a bridge loan. It's really just a bridge loan from a private lender, an unregulated lender. So what are the benefits of hard money loan? Why do investors, first-time flippers all the way to investors with thousands of units? So I've closed over $1 billion in hard money loans, and I can assure you one thing, not every project qualifies for hard money.
So one of the most common mistakes I see borrowers or investors make is that they just don't understand the loan terms that they're being given. You know, they're so excited to have an investment property that they're looking to buy that they go out and they go to the market. They might go to a private money person that's lending, 2 or 3 loans a year. They may be going to a lender like myself in asset-based lending that's a regional lender. They may be going to a national lender. It doesn't really matter, but they're going to that lender. They're all excited. They have a super optimistic view of everything, and they go in and they accept whatever the terms are that are provided, and they're not really understanding everything. Some lenders will make that 6-month loan knowing that more often than not, that loan will need to be extended, and that's where they'll make up their additional fees. But in the process, you'll be really stressed because you'll be dealing with the lender in the face of a maturity default. So it's best to understand the terms. Obviously, in this particular instance, not understanding the maturity date is a critical mistake. So many things can go wrong in an investment that would require more time, and you should always plan for things to go wrong and protect your costs, fix them over the term of your investment, the term of the loan. And by taking a little roll of the dice and by going to a shorter term lender just for that additional savings, puts additional stress on projects, will add likely more cost to the deal than you thought originally, and ultimately it's just not worth it. So pay attention to the maturity date in particular, and understand that the lenders have every right to move at that point to foreclose and to force you into paying fees that you weren't expecting when you first approached that lender for a loan. So this sounds silly, but there are investors out there that I've seen that simply don't even know what their cost of borrowing is. They're so happy to get a loan that they come to me months later saying, I don't even know what I signed up for, why I'm paying interest, a lender on money that I didn't even borrow. So what I see from time to time is borrowers sign up for loans where they're actually paying a higher interest rate and they don't even know it. One example of that is Dutch interest, right? So lenders like us will charge interest on drawn balance. So if you're funding an acquisition and a flip, only charge you interest on the amount we fund at closing. Then the construction escrow will sit there and you won't be charged interest on it until you until you call for an inspection and draw money on the escrow. Now the balance goes up, our interest goes up. Well, so some lenders will charge interest on the full amount, even though you didn't even borrow the construction money yet. You're getting charged interest on it. Optically, it looks like you're paying a lower interest rate, but the fact of the matter is you're paying interest on not just 70% of the total loan, but maybe 100 cents on the dollar, if you will. And therefore, your total borrowing costs are a lot higher with lender A than they would be with lender B. The other thing is, prepayment penalties will get structured in from time to time. I've seen bridge lenders charge minimum interest requirements where, if you don't draw on the construction escrow, the lender will at least want to have made a certain amount of money and will charge that on payoff, like a prepayment penalty. By not understanding the terms that you're getting yourself into, you're putting yourself at risk, not just financially, but if you're doing business with the wrong hard money lender. The hard money lenders that give us a bad name, those are the lenders that are going to be opportunistic when you decide not to pay the loan off before maturity and pursue foreclosure. Because they know they're lending at a low LTV, right? They're going in at a value at, say, 70% of the after repair value. If you execute the renovation perfectly, you make all of your payments and you get to maturity and now you're in maturity default. You've done everything perfectly up to that point, but you have a lender that you don't know how is going to react. They could charge you fees. You're really at their mercy at this point, and you need to trust your lender to be able to extend, to do so in a cost-effective manner, and to give you the ability to execute and exit the deal. Lenders want you to succeed for the most part. I know I do. And to me, to go in knowing all the different aspects of the transaction is the most important thing. So I spend a lot of time on the first deal First deal is always the hardest. I don't care what they say. It's the first time doing business with somebody, a new institution. It's critical that you understand and ask questions. And I'm here to help and happy to help. DM me with your questions, ask comments, and down below for sure. I love to hear the community ask questions. I love to answer questions, and I want to make this more collaborative because lenders have different terms, different ways they approach the business. It's good to understand the different nuances and make sure that you're approaching the lender that matches your investment style. So the next big mistake is definitely investors, borrowers overestimating the after repair value. Your property is going to be appraised on an after repair value basis. It may happen on a desktop with lender A, it may happen with lender B as a BPO, it may happen with lender C as a full appraisal. It doesn't matter, one way or another, that property is going to be valued. We're going to rely on that value to structure the loan. Now, let's talk about how potential horror story that could come out of that, right? So now the borrower comes into us, is overestimating the after repair value as being much higher. We structure all of our loans so that we fund 100% of construction and, let's say up to 90% of purchase. But ultimately we're solving for a 70% loan to after repair value. We don't want to be higher than that. So now the value comes in lower, right? We have to reduce our loan to not be higher than that 70% loan to ARV. We're reducing the loan. We're always funding 100% of construction. So now what happens is the borrower's down payment is going up because our loan is being reduced. So now the overestimation of the ARV resulted in the borrower effectively not finding out until 2 weeks later, right at the time when they potentially need to close, the value is lower and that they need to bring more of a down payment than they thought, potentially putting the deal at risk completely. So that's the one big thing. The second thing is that you also probably have a deposit on the line. You're putting money up with the seller who's looking for you to execute. A lot of the times my borrowers will use me like cash because they know we execute, right? They know I've done so many transactions. They're going into these deals competing with a cash buyer. They're coming in just using me like cash. They know our processes, but they're so confident in our ability to close that they just say, let's do it. A lot of the times these guys have cash too, by the way, but they're looking to deploy those the cash into other deals. So they're coming to me and they're saying, I'm allocating this to this investment and it needs to be that. And oftentimes when the value will come in lower, when you're not experienced or you're looking to, manufacture or create value beyond the market, which certainly can happen, but it's not common. You have to anticipate where the value might come in, understand where your cash might need to be, and be able to adjust on the fly without putting yourself at risk. So the next big mistake is definitely borrowers not having a clear exit strategy. And on this channel, you will hear me stress, know your exit strategy. You should know how you're making money. You should know what your plan is before you approach a lender. If you think you have a plan, you should go through it 4 more times to determine that, you still have a plan, because at the end of the day, you have to be able to pivot. You have to understand that some transactions aren't going to go the way that you think. How am I going to exit deals? Not one way, but 2 ways. Maybe I don't want to always rely on a sale, because what happens if the market softens? Because believe it or not, markets don't always go up. You have to be prepared to refi. So a lot of the times lenders like myself will come in and say, listen, we're going to do a fix and flip with you, but we want you to have a minimum credit score. Well, why? Because we want you to have a plan B, have the ability to refi into another loan in 11 months if you can't sell it. One way or another, you want to be in control of the exit. You need to plan for both scenarios and be able to exit via sale if that's your primary, but know that the refi is always plan B if the market goes down and you can't sell it for what you're in it for example. Make sure that you're always protecting yourself by knowing your exit strategies. One of the mistakes that can cost you the most money and put you in the biggest bind is not intimately understanding what the renovation costs are going to be for a project. I always say the best flippers are both real estate agents and contractors. They have both disciplines down and they know the value, but they know the renovation costs, right? You can think you know what it's going to sell for. You have that ARV, you know the value so well. You're the best real estate agent in the market. You know the product that needs to be delivered to be able to achieve that value. But guess what? You don't know how to swing a hammer. You have no idea what you're looking at when it comes to renovations. situations, well, you're at a massive disadvantage because you can't know how much money you're going to make unless you know what it's going to sell for and then what it's going to cost to renovate it to get it sold for that amount. And it's part of the equation. It's the biggest variable. And I did a project where they were buying this nice single family split level. One of the biggest costs associated with one of these flips is the kitchen and the bathrooms. It's what it is. So I went into the deal. I underwrote it. It was with my debt fund. We did the transaction. We underwrote it with an extraordinarily high budget. It was underwrote to over $100 a foot in a cosmetic rehab. But we went in and we knew, this was one of our first projects on our own. We wanted to be conservative, and so she went into the deal. We were funding and everything was going great until she opened up one of the walls because she wanted an open floor plan, and she didn't realize that, the structure didn't support the open floor plan, that she needed a micro lam beam to run across the entire length of the house to be able to open up the floor plan. And she had already gone ahead and done most of the work. And it just opened a massive can of worms, and it continued to snowball. Her project went from costing $150,000 going in to costing over $300,000, which would have basically been around near the cost of building the house almost new from the frame. The borrower maxed out all of her credit cards and got right to the maturity date. We gave her more time. She became more and more delinquent. And thankfully, the market had gone up enough where she was able to get out by the skin of her teeth, lost only, I think, 50 grand, but was in a position at one point to lose probably over $250,000 if she had ended up in foreclosure, which is what she was facing had we not, continue to work with her. So another mistake is you just simply choose the wrong lender. Some lenders don't do construction lending well. Their draws are slow. Some lenders can't get to closing fast because they have a lot of red tape. Some lenders don't control their money. They need permission to extend loans. Ultimately, for me, it comes back to relationships. It comes back to, trust. It's both ways. With lenders, for us, we trust your information and then we approve loans and we verify. You have to be doing a lot of the same type of work, but doing it more upfront. So come to lenders like myself, ask a lot of questions, bring all your questions. Let's talk through the programs, ask specific nuances to post-closing, requirements, partial release provisions, payoff statement timeframes. All of these things can create anxiety for a borrower if they don't know. Hopefully by viewing videos like this, you'll learn a little bit more and you'll go in eyes wide open so you don't get caught in the end adding stress to an already stressful project or worse yet, having an impact to your profitability. These are real examples of mistakes that borrowers have made that have cost them thousands. And it's definitely cheaper for you as a viewer to learn from their mistakes than to go through and make these mistakes on your own. And so for that, I'd appreciate a like, a subscribe. I'd like to thank my sponsor, Asset Based Lending. Please, follow me. You can find me at Mike Chadwick, JR. But again, thanks for watching and stay tuned for more videos just like this one.